For the last several weeks, we've been talking about the effects that equity bear markets are likely to have on investor emotions. The reason I've spent so much time discussing these effects is because bear markets can really be defined as the key make or break moments for most investors. They bring out incredibly intense emotions, and managing that emotion is one of the most important skills we can develop as investors. Bear markets have been described as a period of time in which common stocks are returned to their rightful owners. Your mastery of your emotion during these times will be the key determining factor in whether you get to be one of those rightful owners. So in that light, as we leave this topic, here's a final summary of our bear market principles. Losing money feels twice as bad as making money feels good. So you should expect that your emotions will be hugely magnified in a declining market. All declines are temporary and are nothing more than an interruption in the permanent advance in equity prices. The market is incapable of inflicting permanent loss on a diversified long-term investor. Permanent loss is only the product of investor panic. In the act of capitulating to avoid further loss, it's the investor himself who creates the permanent loss. It's impossible to overstate the negative effects of doomsday financial journalism during a major decline. The motto of the financial media is, if it bleeds, it reads, and bad news sells. So we must always stand guard against the effects of negative media on our emotions. In the end, you can only withstand the impulse to panic to the extent that you're prepared in advance to experience equity market volatility. The more educated we are about the realities of historical market volatility, the less chance that we'll be surprised by it and panic the next time it happens. We must deserve the right to be equity investors through our ability to manage our emotions in times of distress. Not everyone will pass this test. Bear markets are the opportunity for the deserving few to prosper by taking advantage of the bargain prices in equities that are created by the panic of the masses. In other words, bear markets are the time when common stocks are returned to their rightful owners.